Okay. Good morning, KWRA. Once again, we are here to give you some great information and look at our panel of fabulous people. So the title of our topic today is Mortgage Lending in Time of COVID. And we have our friends Howard and Randy with us from Cityscape. We have also asked Max Heckenkamper to be with us as kind of our agent representative to speak from the audience side of things. And of course, Jessica is here with me to participate in facilitating this time with you. So I think this is going to be a real good session for you. And I'm glad that you are joining us. And of course, you have either found this on our YouTube channel or maybe Facebook when they post it. So I am going to begin with a couple of questions, and Randy, Howard, you decide who wants to address this. Obviously, the stimulus bill is on everyone's mind, and there are a lot of different opinions about shouldn't, do it, do not do it. Homeowners and prospective buyers are asking people a lot of questions about this. And what in particular do you think homeowners need to know about that bill?
Well, the stimulus bill that was passed included a clause that allows homeowners to forbear their mortgage payments from anywhere from 3 to 6 to 12 months in increments like that. So by request, without harm to their credit, a homeowner can ask a home servicer, a lender, to allow them to miss up to 3 payments, and then they can do it again for 3 payments or up to a full 12 months. And so that's the clause that homeowners are asking us about.
Okay. And so what is so is that for everybody? Is that just a blanket, whether you need it or not, just go get it?
Well, unfortunately, that's the thing. They didn't put a lot of restrictions on it, but there is one big restriction. The big restriction is that the home loan has to be serviced by a mortgage-backed loan that is backed by Fannie, Freddie, FHA, Rural Development, or a Native American 184 or VA. It has to be one of those kind of traditional loans for it to be eligible for this program. So if you have a construction loan, a jumbo loan, a bank service loan, a short-term loan, a second mortgage, they do not apply. It has to be one of those loans that is kind of insured by one of those kind of quasi-government agencies that I mentioned. So if they have one of those loans, they can request from that servicer a forbearance of their loan. Well, what we're getting, Randy and I, and every lender in America, we're getting lots of questions. People are calling in saying, well, why wouldn't I take it? And Randy, what are you hearing from our clients on it?
Well, they are calling up and they're asking if they should put their loan in forbearance. And my response is this, you know, if you have to, if you've lost your job and you have absolutely no other way to make that payment, then yes, that's what it's for. But if you have a way, if you can borrow money from a family member, or you have it in savings, or if you just have another way to make that payment, do it, because it's not going to just be tacked on to the end of your loan. That's what most people think. They think, oh, I'll just skip a few months, it'll go on the end of my loan. That's not how it works. It's going to be like an escrow shortage. And if you've ever had one of those, it's not fun. The lender basically comes to you and says, you have 2 choices. You can either make a lump sum payment to catch up, or you can pay it out over time. And if you're short money already, that just puts you in a hardship situation, and you're just basically kicking a can down the street toward foreclosure is what you're doing. So if you need to make those payments, which you do need to make them. If you can.
And we want to be clear, lenders are looking at this differently from lender to lender. So what in the bill, it does not account for a way that a mortgage lender has to do this. And so what Randy said is correct. So for example, we had a client send us their approval for this that they got via email. And it said in the approval that when they come out of forbearance, that they should call the servicer, and they will at that point make a decision if they will either spread those over a 6 or 12-month period, or they may, here's the key word, they may allow it to be tacked onto the end. But what the key point of this is the mortgage servicers do not have to agree to any certain terms of that. They could literally say, you owe us all the money. But the truth is, I'm going to be, blunt, nobody's going to do that. Nobody wants homeowners to be foreclosed on. But they could very well say, hey, you did it for 3 months, let's spread it out over 12 and pay us back. And that's going to be a very likely scenario. We may see people having to have an increased mortgage payment for either 6 or 12 months because of this. The same thing for your taxes and insurance. Those taxes and insurance payments do not go away. And so let's say that the mortgage lender servicer really does allow you to tack it on the end. Well, I'm just going to use rough numbers. Let's say that the interest and taxes and insurance are $15,000 on your mortgage and you owe $150,000 on your house. Suddenly they tack it on the end, you now owe $165,000. Well, what if your house is only worth $160,000?
Yikes.
So, you're setting homeowners up for being upside down on their loans.
Wow, that is huge.
But also, a lot of people have told me that they've called just to ask about it, and they're being told that they will show up as a late payment on their credit report. And that right there is just a deterrent. They don't want that, because if you have a bunch of late payments, it can prevent you from buying houses later.
It will, but I will tell you this, in the bill, it does protect consumers. It cannot show up if you do it properly. And this is the key thing. And this is why what Randy said earlier is that realtors should be calling all their past clients. This is a great opportunity to educate people. We're doing that. We highly encourage people to do it because, again, I want to reiterate what Randy said. If a homeowner needs this, it's there. If you've lost your job and you cannot make your mortgage payment, call your servicer and you say, I have been affected by the virus and I've lost my job. I'm on, I've been furloughed. I cannot make my payment. They will say, that's fine. They will agree to it. They'll say, we will forbear it for 3 months. And that's the difference this time is they cannot question the homeowner. And so that's the fear in the market, that people that don't need it are going to take it. Well, they're going to just think it's free money. It's not free money. You have to pay it back. And there is a repercussion to that. Now, I will say if you do it properly, it will not count as a late. So that person who got that late, they probably just went ahead and missed a payment, then called. You have to call first. Make your mortgage payments always before you get permission to miss them. So if you call your mortgage servicer and you say to them, I need the forbearance, they'll say, great, we'll send you the form. You have been approved. Do not miss your mortgage payment until you hear those words. Once you've heard those words, you've been approved, it will show up on your credit report as your loan is in forbearance. That's what it's showing up. We've already seen it. So it will show up as your loan was in forbearance. Now, what they've done is that the credit bureaus are not supposed to take that into effect on your credit, but no one's going to give you a loan while you're in forbearance. I will tell you that. It will pause everything. You're not going to get a new mortgage. You're not going to get to refi to, go get a new auto loan. Everyone's going to see that on there until you're out of forbearance. So again, it's designed to help people who need it. But unfortunately, like lots of things in life, when you rush something, which is what they've done on the stimulus bill, they rushed it out to help homeowners and the consumers out there. They didn't think about the other end of it. They didn't think about these, the truth is that it should have had something in there to say, I have actually lost my job. It should have been the people that have been laid off. It shouldn't just be anyone. And I will tell you, we've had very well qualified people call us and say, well, should I do this? I mean, I've had people that have jumbo loans call us and say, well, hey, shouldn't I do this too? It's just free money. because they think that somebody else is going to make these payments. But they're not going to get made for them. They're ultimately going to have to make them, and they're going to end up getting tacked on, and they're going to pay interest on the interest that they owed, which is, to me, not a good thing.
Max, did I see your hand up?
No, I didn't have anything specifically to say about this, but I spoke to Howard, what was that, last Thursday, Howard? Kind of about the same thing. And, I always felt that there are going to be those people that have no need to use this, but are still going to try. And they're going to put themselves in a bind at a certain point. And that's just, I think it's human nature, unfortunately. But, I like this message. Don't do it unless you need it. If you got laid off, if you lost your job, if you're furloughed, talk to your lender. And this is why, I had this conversation with Howard last week, and why I'm happy to be in this one this week is because, as I talked, it's hard to talk to all of your clients in a timely manner while this is going on. So I feel like this is a better reach and a little bit more tact, because a lot of your clients, when you talk to them, from my experience so far, aren't just going to say, hey, I lost my job. Most people aren't just going to volunteer that information. So I think that as agents and lenders, we need to find a better way to help talk to more people so they know how to get the help that they need.
Well, and that's a great point. So that's where, agent recording a bomb, a video, sharing it to their clients, talking about this. If you have questions about the stimulus bill as it applies to your mortgage, call me. Call your lender, talk about it first. The other thing that's very important is people that are actually just closed on mortgages are calling and asking us about going ahead and taking the forbearance. And the thing we have to tell people is that in those situations, often you have to make 1 or 2 payments first, because again, it does not apply unless the loan is insured with Fannie or Freddie or HUD. And if you close a loan today and then you say, I'm going to take forbearance, it hasn't been insured yet. It's just sitting there, and it's not been insured. It's not been placed. Therefore, it's like Howard carrying your loan. And if you try to do that, unfortunately, it's not protected under that bill. And so again, it's about communication. And so in the case of Randy saying earlier that somebody may have had a late payment, if they didn't actually make 1 or 2 payments and then they just chose to miss a payment on a brand new loan, it could be that that wasn't insured by one of those agencies that are approved to do this. So again, I highly recommend that this is a time that everybody in our industry reach out to your past clients, talk about this, and it's a good time to be the expert, the educator, and help people to understand that yes, if they need to take it, it's there, but make sure they're understanding where their loan is.
I've had people ask me if it's a way to take a break from making mortgage payments.
Yes.
And so I tell them, no, it's not a way to take a break. If you're still employed and you have ways to make your payments, make your payments.
Correct. Yeah. But the truth is they can, and that's the scary part. And that's what everybody in our industry is worried about. Our industry, they passed the stimulus bill, and they didn't put any requirements to prove you've been affected by COVID. They also kind of left this open-ended. And, so there's these people out there that are going to do it regardless. And what will that do to the rest of us in our industry?
This is interesting because this happens often in any business. We've done it here, where you come up with these fabulous ideas, and what you don't think about until you get in the weeds with it and things start to happen, those are what I call, and I didn't coin this, Gary Keller actually coined this, and somebody probably coined it for him. Those are the unintended consequences of really good decisions that are well intended, but the back end of it wasn't properly looked at, and then can cause an even bigger problem at the end. So I think this brings so much value. So I want to ask you a question. How does this differ? How does today and what's going on differ from 2008? So 2008, what happened in 2020?
Well, it's a giant difference. You know, first and foremost, in our industry, we, like everybody else, we understand that this is specifically because of a virus. So what's happened is very unique. But back in 2008, it was a flaw in the process of the mortgage industry around the world that brought the world's economy to its knees. And it was a fundamental problem with the way that mortgages were packaged up and sold, and they were packaged with good loans, with a lot of bad loans, and it brought our whole economy to a halt. Well, today it's the opposite. It's the shutdown of the economy combined with the stimulus bill that has caused a huge disruption in the mortgage industry. And so and that was a great description. An unintended consequence of that stimulus bill is that it's caused an incredible worldwide credit crunch and in our mortgage industry. And so what we're experiencing is this huge fear of the people that are going to take advantage of this bill. How many are going to take advantage of it? It was passed with the idea that consumers would just do it on an honor system, and that we would see the average person doing it from 1 to 3 months, and that the economy would just rebound after 1 to 3 months, and that would be it. And that we would only see people that were what really needed it to take advantage of this. But what we're seeing in the industry is that's not the case. We're seeing people are just going to take it. We're going to see people that don't need it take it. And so there's an estimate between 10 to 25% of homeowners may take some form of that forbearance on their loan. And that's up to a quarter of homeowners may choose to forbear their mortgages from 3 to 6 to 12 months. If that happens, that could cause mortgage servicers to go bankrupt. And because they in that bill, they did not put a clause, they did not put any kind of device built in for mortgage servicers to be able to make their third-party obligations. And so this is a very complex world, mortgages, but the simplest answer is that when a mortgage bank loans a consumer a mortgage, they're not loaning their own money. No one. So when people are like, well, I want to use this big bank down the street because they're going to service my loan. Well, they may be the servicer, but they're not actually lending their own money. They're lending somebody else's money in a bond, a mortgage bond, a mortgage-backed security, or it could be Fannie or Freddie. Well, in this bill, they did not provide any kind of freeze for making those payments. So it'd be like me saying to somebody, well, you can stop making your car payment and all your utilities, but then the utility company, the car company still have to make all their bills. And that's the case with the mortgage companies, is that the mortgage companies, they get to skip, mortgage holders, like the homeowners get to skip making payments, but we still have to make payments to other people. Mm-hmm. And so that's caused this huge fear in the mortgage industry. And that's why we're seeing some mortgage lenders tighten up their requirements, just like in 2008. But it's not because they messed up. It's because this stimulus bill has caused this to happen. If that makes sense.
Howard, do you have any predictions as what this stimulus bill could cause, unintended consequences wise a couple years from now? If somebody chooses to push their payment out 12 months, they don't need any part of the stimulus bill. They still have a job, they're still working, they just don't want to pay, and then they're upside down like you said earlier. I mean, is it possible that the mortgage companies did not cause a problem this time, but there's still a mortgage problem in the future?
Well, I will tell you, yesterday, Fannie and Freddie agreed, and this has just happened, which is calming the market some, that they agreed to put a stopgap. They have agreed to a 4-month stopgap. So at this point, if consumers quit making payments, they're only required to make, the mortgage servicer right now, if you have a Fannie Freddie backed loan, will only be required to make 4 interest payments on those bonds. So now these mortgage servicers, these large mortgage servicers can go look at their book of business and they can start predicting, will they have enough money to survive?
Okay.
And the truth is we're already seeing some people that they're not going to survive.
Hmm.
And because they passed this bill that says you have to make these payments regardless, there's some people out there that won't make it. Others are getting more conservative. And so, for example, we've seen a couple people in the market, not us, but we've seen a couple people in the market raise credit score requirements to 680 and require 20% down payments to get a mortgage. And it's one of the nation's largest banks did this. And the reason they did it, they are also one of the largest servicers. So they looked at this and said, oh no, we can't keep getting loans that people are going to just end up forbearing, and we're going to turn around and have to pay our mortgage-backed securities. So we're going to say, stop. We don't want any more loans. A large company here in town that is based in Oklahoma, not us again, they did the same thing. They said they're a huge servicer. They do more business around the country than they do even locally. They raised their credit score requirement to 680. Well, the thing I will say, I believe strongly that this is temporary. I want everybody who's a realtor to realize that if you work with a lender, and I'm going to be very nice about this because it's happening to everybody, if you work with a lender that isn't me and Randy, and your lender tightens their credit score requirements up, it's going to be short term. This is a unique time that none of us anticipated ever happening. And I believe very strongly that from a industry standpoint, we all need to realize that. And this is and provide a lot more grace in how we respond to these situations, because these mortgage companies and servicers that are taking these big steps to protect their business, that's what they're doing. They're taking steps to protect their business in a hope that it will not bring their business down completely. And I appreciate that. Yes, Jessica?
I have a question. So what happens to a mortgage company or a bank or servicer who doesn't survive this? And if they sell the loan, does the loan term payments, anything like that, does that have an effect on the consumer as well?
It won't have any effect on the consumer. And so if a servicer does go bankrupt, and there's been some that ceased operations, there's some like Loan Depot is a large online internet company. When a couple of weeks ago when this bill was passed and the mortgage companies realized that it didn't have a clause on how to make those payments to the third parties, there were companies around the US and around the world that just stopped operations. And they just said, whoa, we don't know what this is going to do. And they stopped. And so some of those have dipped back in because they've realized that it's not as bad. But if somebody does go bankrupt, they will actually sell their book of business to somebody else. So it's protected by Fannie, Freddie, FHA. So consumers are protected. In this time around, they're protected more than they were last time, which is wonderful. But the difference is what's so interesting is the CEO of Mr. Cooper, which is one of the nation's largest servicers, helped write the beginning of this bill. And he also told them how to do the ending of the bill to fix this. They just did the beginning. So they just took what he said for this piece and they threw this piece out. And that's what's happened. Unintended consequence is the best way. Yeah. And so we're seeing somebody asked us the other day is what else in the credit world is changing? And, so across the board, different lenders are making different changes. One of the changes we saw was the bond loan. It's a very popular first-time home buyer program. They've raised their credit scores up on that bond loan program much, much, much higher. The threshold to get that bond loan program is much higher than it was a month ago. But that's across the board. That's all lenders have that. And so what you're going to find is that there's going to be less people who actually qualify for that bond loan than did a month ago. But yet I feel very strongly that in 30 days, it will lighten back up. In 60, 90 days, we'll see a change.
I have a question on that bond loan. So you have a first-time home buyer, and they have a bond loan, and they got approved. If they're in the middle of that, can the lender change the rules of the game in the middle of that, and now they don't qualify? Because I think I'm hearing that.
That's a perfect. We've done a lot of talking about this. They absolutely can. In our case, you know, we've done everything we can to honor everything we agreed to honor when we take a contract. You know, one of the things that we have gotten more conservative as a company is unique properties. Unique properties would be mobile and lots of land, or a metal home. There's some types of programs that have less of appeal to those servicers. But anything we had to start, we've honored it. But I will tell you that there are lenders here in town that didn't do that. And they got to the table and said, I'm sorry, I can't close your loan.
Yeah, that's what I've heard.
Yeah, there are people that got all the way to the table. We have honored everything that we can all the way to closing. And so we've not done that, but there are people that will.
So the secondary question to that is, then can they get any kind of loan? So let's say, okay, I can't get that bond loan. Can I start over again? Can I go a different direction?
Yeah. Well, that's what we're doing. Is Randy's really good at this. She always has been. Is that we look at, the truth is that I've always believed that a homeowner, if they have the means to put some money in a house, are better off putting some money in the house, period. I just always have believed that. And that's what I shared with Randy. And so Randy has always looked at it that way. And so often I will tell you, what percentage would you say, Randy, when you have somebody who can go bond, that they can also go regular FHA?
Say most of them, when they're shown the actual facts that they're going to get a better rate, they can often find a way to come up with a down payment, whether it's asking a family member for a gift, or just maybe getting it out of their 401k, or maybe it takes them an extra month. They can figure out a way to come up with the money. So I would say it's a very high percent of.
So that might be a safer way to go at this time then, huh?
Well, and the truth is that, you know, they raised the credit score requirements. The truth is, most of the time, once you get to that threshold that they've raised the credit score requirement, the people will likely have the money for the down payment anyways. And so, you know, it's kind of statistical. Once you get a higher credit score, people typically have money for a down payment. And so it ends up being that it's not even needed at that point. And so I would say 80% of the time when Randy gets a pre-qual for a bond loan, they can end up coming up with a means for their own money. You know, so there's other options. And there are other options for those other borrowers. It just may mean that they need to wait a second, you know, or if, for example, some of those loans out there that couldn't close with those other lenders, we're closing some of those. So there are still options out there for those people. And unlike 2008, where we saw the pendulum swing so far conservative for 1 to 2 years, I mean, we spent a couple of years where the requirements for lending were very, very tight. Mm-hmm. We don't think that's going to happen. Our advice we're getting from our industry experts, Fannie, Freddie, HUD, they're telling us that they're actually on the announcements, they're saying temporary. They're saying this temporary guidance for lending. And so we're seeing things to May 15th, we're seeing things to June 15th. And so I have been telling my team that let's just count on this to July 1st. Mm-hmm. I think that about July, we're going to see our world and lending get close to what it was pre-COVID.
Mm-hmm. Okay.
I think it's important to mention too that, you know, even though there are some extra rules and stuff happening with other lenders, in Tulsa, people are still buying houses.
Yes, they are.
And we're still pre-approving people, and we're still busy, and busy people stay busy. And I tell this to agents all the time that, you know, if they're reaching out to their past clients and they're doing their lead gen during this time, they're going to come out of this way ahead. I mean, it's not doom and gloom as far as, like, you know, keeping yourself busy. It's not. There's still people out there.
You're right. And what's important for everybody to know is, and I think we've said this in every video we've done, but it bears repeating, is, you know, the buyers or the sellers we may have lost temporarily are those that just want to sell their house or want to buy a house, but they don't need to.
Mhm.
There's
Yeah.
still a lot of people out there, and will continue to be a lot of people out there that need to sell their house for sure. And then, of course, there's going to be people that need to buy a house, and those are the ones that we still provide tremendous value for. And when we then can advise them properly on these type of topics, we bring them even more value to the table. Speaking of that, what about the pre-approval side of this? What does that look like?
I'm glad you mentioned that. So the thing I will say is that people are asking us what additional things are being layered onto a pre-approval today. The truth is it's not different from before. You know, it's just we're being more conservative on double checking. So for example, anytime you've ever gotten a mortgage, there's a presumption that the person getting the mortgage will have a job for the next 3 years. We make that presumption. So if a home buyer is taking out a mortgage and they know that next week they're going to be furloughed, then they shouldn't be taking out a mortgage. So it's always been that case. If you know you're losing your job, you shouldn't be taking out a mortgage today. Your loan would get put on hold this month, as same as it would have been in December. But the difference is we're finding it's happening today. We're actually finding that we're in the middle of a loan and we get that terrible phone call where that homeowner, you know, the prospective homeowner says to us, I just lost my job, or I just was furloughed for 2 weeks. Well, that person that was furloughed for 2 weeks, and here's an example. Cherokee Nation has been amazing. They've continued to pay our employees for this whole time. However, they just announced they were asking their employees to take a at-will furlough for 2 weeks. And it makes sense. They can take the stimulus bill, they go ahead and get unemployment. They know that they're going to be back to work right after this. Well, if you have a mortgage in the middle of the mortgage loan process with somebody who works at Cherokee and they were being paid and they suddenly go on furlough, we pause. And we will pause until they go back to work and we can verify that they're back to work full time, and then we will resume the process.
So you keep the application open.
Yeah, absolutely. Yeah, we're not turning them down, and that's the other difference today than it was, in 2008. We in the industry look at this as being out of homeowners' control. This is you're trying to avoid getting a virus, and so if they're not working and they have to pause their loan, we're just doing that. We're pausing their loan, and so for example, Fannie and Freddie came out and said, we do not count this as a gap of employment. If somebody's furloughed for 30 or 60 days because of COVID, we will not count that against them. Now, they have to show they're back on their job. They have to show that they're the same hours and stability. So for example, we've been looking at situations where somebody is a manager of a restaurant. Well, if the restaurant's closed, we're being more conservative because we have to make sure that the restaurant's coming back and they're being fully paid. If they're a waiter and their earnings come from tips and they're not receiving tips because the restaurant's closed, we can't close their loan. But if this was December and the restaurant was closed all of December, we couldn't close them then either. So it's the same requirements, but we're just experiencing them more frequently because of something out of the control of everyone. And so Fannie and Freddie and FHA are now requiring that we verify employment the day of closing without exception. And that's we're finding that we have to actually, call and verify. And so that's creating some challenges. We had a loan that was supposed to close Monday, and we started alerting people last week we would need somebody to verify employment within 24 hours of closing. We did not reach anybody who would do that for us until Tuesday, and we were supposed to close Monday. Well, it was a school person, and they could not find anybody. They've known for weeks. We sent out an email and said we have to verify employment, and they could not track down the appropriate person to verify employment until it was a day late. Well, clients, realtors, everybody knew. Everybody knew a month ago. Everybody knew 2 weeks ago. Everybody knew a week ago. Everybody knew Friday. And it's just because of the virus. You know, that person was working from home and they were unavailable and they finally showed up. So
Wow.
it's not normal. Normally that's a thing that's easy to get a hold of somebody, and then, you know, the school admin office.
Can I add something to that, Howard? So, you know, once we kind of realized that a lot of people were going to be working remotely, we tried to be really proactive in that. And so, you know, like I sent an email to every single client that I had in my pipeline and said, hey, if your HR department is working from home, please get their cell phone number because we're going to need to verify employment the day of closing. And I was able to get that cell phone number from every single person in my pipeline. So there's a way to be proactive, and I think we've done a really good job of that. The other thing that we had people do was, you know, the IRS employees, they stopped working in the IRS office. They were all working from home. So when lenders place an order for transcripts, which is something we have to get on self-employed people, we couldn't get them. So we just had the client themselves go to the IRS website, order their own transcripts. I mean, it takes them a couple minutes, but they got it immediately. And that was a way we were able to get people closed and pushed through without waiting on
Think out of the box a little bit, right?
Yeah, for sure.
Yeah.
Yeah, that was a great email. And again, immediately when we as a company put out an email to all of our loan officers, and Randy said, hey, I've got this. And so she sent a video and an email to everyone in her pipeline and said, I'm going to need your help. It's a unique period. In a normal case, we don't want to bug you. And that's the truth. We generally don't. We want to make the mortgage process as seamless and keep the client out of it as much as possible. But right now we're saying, we need your help. We need you to be active and involved. And that's what Randy did.
Isn't that, boy, that is so cool. And kudos to you, Randy, because that just goes to show over communication is so important in times like this. And I hope that doesn't go away when everything goes away. I hope the art of communicating at a really high level stays at a really high level. That's beautiful. And how appreciative those people must have been that you did that.
Yeah, well, they all got to close, and that's all anybody wants. That makes everybody happy.
Yeah. So, Max, so you did this type of thing with Howard, and you did that for your clients and then put it out to your clients.
Mm-hmm. Yes.
So what kind of response have you gotten?
Overall, pretty good. So kind of touching back to what Randy was talking about earlier about, you know, this is a good time to reach out to all your clients. When we first started working from home, and I would go through my database and just start calling people that I was, you know, would typically call, I felt it was a little bit more challenging to have those conversations. You know, you call to say how you are, but it's really hard to just say, hey, you know, anybody that wants to buy or sell a house. And, you know, like I said earlier, a lot of people, if they're struggling with work, they're probably not just going to come out and tell you. So what I've changed to is I have some really good text messages that I've been sending people. And if they respond to me, I know that they want to talk. And from that, it'll prompt a conversation. But then, yeah, I mean, I just thought that was a softer way because, you know, everybody's at home and answering the text is pretty easy. If they just say, hey, thanks, I hope you guys are doing good. I know they don't need me right now, but, you know, I wanted to make sure they're okay. But then when I get the questions coming back, you know, what are the lenders doing? We're thinking about doing something. That lets me know what they are thinking about doing and probably what they were thinking about doing this year before everything changed. And so then I thought, you know, with the stimulus, and I think last week everybody started getting their checks from the government. And I think people were saying like, well, what do we do now? I've been a lot busier with conversations in the last week, really, as far as people like reaching back out. Hey, we're really thinking about doing something. They've been at home for a long time. And I think they're a little bored, frankly, and just ready to do this. And so I thought a video with the experts, because I'm not the expert on the stimulus bill. I know what it is, but I don't know as in depth as Randy and Howard do. So I thought, what a good way for my clients to be able to see something when they have a minute and, you know, let me know how they need my help, or call Howard and Randy or whoever their servicer is to get the help they need.
Max, do you find that you're getting good response from that? Have you sent out those videos yet, or?
Yes, and I did some last week, and they've gone out. Honestly, the video that Howard and I did last week is getting pretty high responses on Facebook where we put it out. I think that was more topical. I think Howard went a lot more in depth today with a lot, and Randy as well, with a lot more information on what it really is. But I just wanted people to kind of have the basics to understand what their options are. And we talk a lot about being an advisor to our clients, and it's not for us to make their decisions. It's for us to help provide them with the information they need so they can make the right decision for them, whether it's a forbearance, whether it's time to sell, whether it's time to buy. And then they have to, I agree with Howard and Randy said, it's a much more collaborative effort now than it was a couple months ago when, we would do a lot more for our clients. But now I got to tell them the same thing, guys, I need your help to get this done because I can't do everything I used to be able to. And so I think the responses are good. I think that people are still kind of waking up to everything now that it's been, about 5 weeks working from home to what's really going on after kind of, getting their head a little bit above water and those things. But I mean, the responses have been a lot better. And I think as we get closer to May, they're going to increase because like right now we have, my Tech and Kipper team has 10 deals under contract. In April, that's not very much compared to what we usually have. But I think that, like Howard said, in July-ish, somewhere around there, I think that, the switch may turn on for all the people that were going to do something in 2020, but just got put on pause for something that nobody could control.
I agree with that completely. And so and I know you guys have sort of your industry experts saying it, and that's what our industry experts have said, is that we had a really, really great kickoff to the year, and we all did. So that's going to help us, with what should have been an amazing spring. But we see our, third and fourth quarters that they're going to be amazing this year. And so because some of the people that have kind of just pushed things out, they're going to come back into the market, midsummer, and you're going to look at a bigger, third and fourth quarter than we generally would have, because some of that business that did pause will come back in as the year progresses.
So go ahead, Max.
Well, I was going to say, there are a couple things that are similar to 2008. I have a more optimistic outview after the scare is over. But, after the 2008 crisis, really, I don't feel like we felt it in Tulsa until 2010. And in 2010, it was a busy January through April 30th. And then when May 1 rolled around 2010, everything stopped. But then I had a really strong third and fourth quarter that year because all the people that would have bought throughout the full year hurried up early, took advantage of the tax credit. And then after enough time passed and people realized another tax credit was not coming around at that time, they're like, well, if we still want to buy a house, we're going to have to go ahead and do it. And so there won't be a tax credit. I know that again, but I know that, people are going to want to do something and take advantage of the great interest rates.
Yeah, rates are still amazing. I mean, that's absolutely true. That's exactly what you just said, is a much more eloquent way of saying what I was trying to say, Max. That's exactly how we feel.
Well, good. I'm glad I contributed.
Yeah, it was awesome.
It was just saying it in a different way.
Perfect.
Eloquence in a different way. All right, so let's just summarize here before we wrap up. So we began the conversation with forbearance. I want you to name off for me one more time, Howard, the traditional loans that can be considered. What are those?
It's all of the traditional loans, Fannie, Freddie, so conventional, FHA, rural development, 184, VA, all of those traditional mortgages can be forbeared that if they're backed by those. And the key is, have they been sold to either the servicer or are they insured? And so again, the key is ask your mortgage lender those questions.
All right, and then the second point to that is that forbearance shouldn't really be for everybody. If people can comfortably continue to make their house payments, that is the more prudent financial decision to make. Is that correct? Long term.
Always. Absolutely. It's designed to help people who need the bill. So if you need to take it, we want you to take it, because it'll give you a breathing room to get a new job, to get back on your feet, but it's not designed for those people out there that were not affected.
Great. And then to Randy's point, this is an awesome opportunity for you all to call your past clients and educate them with this information. And then possibly you're going to find out in those phone calls, they do need to go ahead and sell their house. So there could be a secondary opportunity. You're bringing them value with educating them on this situation. And then at the same time, you may also get additional business, or you may get into a conversation about when this is over. We definitely are going to want to do that. And one of the things Randy's doing, and I know that it's very easy to do, isn't it, Randy? The bombs. It's not a really big deal. That would be a really fun thing for you guys to do if you want to do something like that for your clients versus a phone call starting out that way. So there's just an idea for you. Let's see, I have, do we need to summarize anything on the raising the credit score? That some of the bigger banks, are have raised the credit score to 680 and requiring 20% down?
You know, the thing is that's a rare occurrence. And so right now we're still seeing plenty of options for home buyers. But the thing I would say is that during this period, we are seeing some tightening of the credit markets. So
Let me can I add something here?
Yes.
Like, we were able to pick up a client that was turned down by a major nationwide bank because they had a non-occupant co-borrower. And so that big lender said, oh, I'm so sorry, we can't do your loan right now. We're viewing you as being too risky. So that's a loan that we were able to pick up, that we could do that, you know, before all this, and we can still do them now. So, you know, it's a good thing to use your local lender, because we do have a little bit more flexibility than some of those big national banks.
Right. Another thing I want to speak to you on that is to remind everybody, if you are working with a first-time home buyer and they are involved in a bond loan, and at the last hour they are told they can't qualify for that now, they can qualify you can call Randy and Howard and they can get them qualified in a different kind of loan. It doesn't mean they can't buy a house. They just can't do it with a bond loan. Am I saying that correctly?
correct. There's just, there's other options. There's other options if they don't qualify for, product X. What we are seeing is that, what's funny is as the industry wide, there's very few loans that actually close at 590 credit score period. There's lenders who like to talk about it, but that that's shrinking because the findings are not going to approve those buyers, and it's really not going to be there. But the buyers that, 99% of what you did anyways, those markets are still there. There's still options for home buyers. They're just, a small percentage are going to be, put on hold for a moment because people are afraid that those riskier credit score buyers and files are going to turn right around and do a forbearance, which is what we talked about before. And if they don't do that, then suddenly you're going to get stuck with a loan you just closed that they're not making payments on. And so there's still lots of options out there for those people.
Okay, great. And then finally, this is so simple, and we talk about it all the time, and that is communicate now more than ever. Max, I loved your system that you've put into place of just starting out with a text and seeing how they react or respond, and then that kind of gives you the next step if there needs to be one, if they just need to talk, if they don't want to talk at all, or whatever. I think that was a magnificent plan and system to use, and everybody in the audience out there, I hope you'll take advantage of that. Now, Jessica, in closing, I would love for you, I'm so excited about what this group is going to do tomorrow live, so I want you to tell everybody what that's going to look like and where they can tune in.
So we are going to be Zooming with Howard, Randy, and Max again, and we are going to be doing it through our Keller Williams Realty Advantage communication page. So basically all you have to do is go to that page and tune in. We'll be doing it at 10 a.m. So you'll be able to do some live Q&A with everyone who's on this Zoom call right now. So if you watch the video and you have some additional questions, tomorrow's your chance, 10 a.m.
Everybody tune in. That's going to be really fun because we're going to be able to talk back and forth. I can't wait. You guys, you're rock stars on this. Thank you, thank you, thank you.
Thank you,
for waiting
guys.
so long for me. And have a great day, and I look forward to tomorrow.
Thank you.
Thanks,
Thank
everyone.
you.
Bye.
Bye.